All right, what up, everybody? This is Jeremy from Escape Velocity Trading coming at you for another market bias update report for Sunday, August 4th and the trading week ahead. Before we dive into this coming week, let's review a little bit about this past week. I ended the week at about a $675 gain. Not what I would have liked, but still positive, so all right with that. And last week we were sitting here opening the week with this doji candle right here directly under the 9 EMA. And I said on both the S&P and the Nasdaq, there was probably more pain in store for the market, that I wouldn't be surprised to see a little bit of a reprieve bump followed by a drop. That is exactly what we got. And now we are sitting down here entering into bearish territory on our RSI, on our MACD as well. And we really don't have a whole lot of support below us if we break below this 5,300 level. This is a really important level. You can see all of the wick highs back here on the last couple of bumps that we'd had in the market. And we are sitting right at that very, very important level. If we toss this out to a weekly chart, you can see obvious slowing momentum. We had this huge run on the weekly chart going back really from August 23rd of last year through until about April 1st, had a significant pullback into the 20, made a next run, but this next run was considerably smaller than that previous one, indicating a slowing of momentum at the top of the chart. We have now broken our 20, so we're sitting similar to where we were at the low of this prior week's candle on that last pullback. We are below the 9, below the 20, and now really just looking to see some development. If, and this is a big if, we are able to go sideways here for a little while and then break out and reclaim the 20-period moving average. In doing so, give the 9 EMA, excuse me, a little bit of time to work its way down and break out of both of those at the same time, I could see a bullish thesis resume in the market. But if we drop back to a daily chart, that movement is really going to be just pushing back up into basically a flatlined 50-period moving average above us. And that is not a particularly great look. So we are going to be looking for something similar to what happened last time. We had a topping pattern, we broke, we came down below our moving averages, bounced into them, set a higher level of support right here, increasing support, and then we broke back above that moving average, the 50-period moving average, which is kind of the line in the sand between bulls and bears. So right here, looking for something similar. I think we are overextended enough after Thursday and Friday. A slight bounce here makes sense, but I am not going to be doing anything more than maybe some day trades on this for the time being. We really need to see a similar pattern develop from here where we bottomed, came back up, set a higher support level, and then broke out if the bulls are going to be back in charge. And if we draw a little diagonal resistance line, we can see that probably puts us out another week or week and a half before there is going to be any real theme for the bulls here to move higher. Also, we had some pretty significant economic data coming out this last week. This week was incredibly hard to navigate as a trader because of just the pounding of relentless economic data points that were coming at us, on top of being in the middle of earnings season now and having a lot of companies reporting earnings and gapping higher or lower by significant percentages. Whether or not they missed earnings beats, missed earnings reports or beat expectations. So between all of the economic data and being in earnings season, it is just a tough market right now to try and navigate. So smaller position sizes are key. If we go out to the following week, so looking at the week ahead, you can see we get a significant reprieve from economic data coming out. We have ISM services PMI on Monday at 7 a.m. And then we have unemployment claims on Thursday before market opens. And really, this is going to be a week where I think we are transitioning in the market. Up until this point, we have been running on the theme of rate cuts are coming. That's going to make it easier for small caps to borrow money and invest back into them. We've been seeing rotation out of the top of the market, both in the S&P and in the Nasdaq, and going into the Russel. Now, that changed a little bit this week, and if charts will load here, come on, Thinkorswim. Let's do it. We want more than one candle. Waiting on the charts. There we go. So right here, we had been at this point in the market with increased momentum on that idea that rate cuts were coming. That was going to benefit small cap stocks. And then what happened? We had a massive sell-off Thursday and Friday to close the week. We are trying to stabilize down here today, Sunday, on the market open for futures, opening here about an hour ago. And what changed really is that the market is forward looking. We are basically baking in expectations that rate cuts are coming now. And up until this point, the idea had been that the economic activity that we had seen had been stable. We had not seen economic slowdowns really in much of our economic data releases, and the overall unemployment rate and inflation rate was coming down. Everything was good. Consumer spending was still up. But on Thursday and Friday, the economic picture shifted a bit, and we are starting to see some softening in the economy. So moving forward, instead of looking for rate cuts as our theme to drive the market, really we need to see, do we get rate cuts with inflation coming down due to an economic slowdown? Or do we see the economic growth pick back up and the economy still holding up going into those rate cuts? And these are two really different pictures, because if the economy is still growing and we get rate cuts, that is really bullish for the market. But if we get rate cuts due to the fact that the Federal Reserve is now scared of the idea of an economic slowdown and going into potential recessionary talk, that is going to spook investors. And we saw that come into the market massively, even though cuts on the Federal Reserve rates would be bullish for IWM and therefore the Russell 2000. We gave back all of that major bullish move. It had a massive fake out on Thursday with a nice pennant formation, which is a momentum indicator to the top side. That instead broke down to the bottom, and we are now right back down at support. Took a round trip on that. So we need to see some stabilization and development. So now that we've talked a little bit about the actual themes driving the market, let's dive in and look at the actual charts, starting back at the S&P. Again, we're looking kind of similar to what we did over here. We broke the 50-period moving average, 9 crossed, 20-period SMA was coming down. Same thing here. We broke below the 50, the 9 crossed it, and the 20 is coming down. So what do we need to see? We are sitting at a really important support level right here in the market. And if we drop this out to a weekly chart, we can see that we have broken the 20 period, similar to where we were at the lows of the previous pullback. Now here, anyone that looks at Elliott wave theory can see we have wave 1, 2, 3, 4, 5. And Elliott wave theory, for those that don't know, usually stipulates that there are 3 bullish moves in any bullish cycle and 2 bearish ones. So we would have the bullish move 1, bearish move 1, bullish move 2, bearish move 2, bullish move 3, and then we get chop and tend to stick kind of in a zone for a little while, and then decide whether or not we are going to break out of the highs, signaling the start of the next 5-wave sequence, or if we are going to break down and reverse and switch from bullish conditions into bearish conditions. So we are sitting at a very, very important place in the market right now. It does not escape my noticing that our RSI is showing bearish divergence, and our MACD also started to show bearish divergence. Now, this happens when you have a high on the RSI or MACD followed by a lower high, which we have on both of these, and over that same time frame set a higher high on the price chart. So you can see the slope of this line is up on the price chart, slope is down on RSI and MACD, signaling divergence. These two indicators are not aligning with what we are seeing in the actual price chart. This makes me think that we are likely to see a little bit of a fight here and then a rollover, and probably coming back down to that 5,000 level in the S&P 500 on the short term. On the daily chart, switching back here, I wouldn't be surprised to see a bump up into about 5,400, maybe 54, 25, 30, somewhere right in there, followed by another leg down. testing back down to 5,200, and if 5,200 breaks, really looking to come back down to the rising 200 period moving average just above 5,000 on the S&P. So it has some work to do if the bulls are going to get back in charge here. If not, lower is probably the least resistance now. Going out to the Nasdaq, basically rinse and repeat the exact same thing. If we toss this out to a weekly chart, again, we can see our divergence on the chart versus the RSI, and also slowing momentum, double top on the MACD. This one didn't show divergence in terms of a lower pivot on the MACD, but set an equal pivot instead. Technically, that is still divergence, however, because we had increasing pivots on the price and equal pivots here. So they still are not confirming one another. So to me, it looks likely that we are going to see maybe a little bit of a reprieve bounce back up into 18,700, 18,800, and then probably a rollover to test this rising diagonal line on the weekly chart. That will correlate out to our weekly moving average, the 50 SMA. Going out to the Russell, looking at on a weekly chart as well. Like I said before, we broke that momentum condition. It came right back down. We are now fighting for support on the 20 SMA on the weekly chart, and a very, very important support level right above us here on the Russell 2000. So it's going to be very important to see if this can reclaim its moving averages on the weekly, clean up the daily chart a little bit and try to break out again, or if this is maybe the sign of not yet and rolling back over into neutrality or bearish conditions. That is really, again, going to just simply hinge on whether or not the economy as a whole and our economic data coming out in the next few weeks signals that the economy's growth itself is slowing down in the face of persistent inflation and rate cuts coming to try to save the market, or if our growth story remains intact, we still see strong economic data come in, and the rate cuts then just become simply bringing back down to the point where the Federal Reserve has the ability to raise interest rates in the future again if needed, without going back above the high that we have hit in our rate cycle here thus far. Going out to the Dow Jones. Dow Jones, looking at this, you can see obviously we had tried to poke our head out of a very major support level, ended up failing it. We are back down below. Again, the story is going to be on the weekly chart here, and you can see this is starting to threaten to cross back into bearish territory on the RSI. We have clear slowing momentum, and we had a really nice pattern here that broke out and faked out and is now back down below that consolidation breakout zone. So here, honestly, if we see this diagonal hold and we can kind of clean this up, mark this as a not yet, see these lows hold, and then clean up a little bit over the next few weeks and try a breakout again, that would signal bullish momentum coming back into the market. If not, if we break down and close below this diagonal trend line on the weekly chart, the next stop is probably back down here to around 38,000. So about a 1,700 point drop on the Dow Jones. Now, going out to Bitcoin, and let's drop this back to daily. And last week I had said if we break out and close above 70,000, that I thought that we were going to see a break of this diagonal resistance line and a re-challenge of all-time highs up just shy of 75,000 and beyond potentially. But that was a big if. We had a little bit of signaling that maybe we were running out of steam there. We did end up rolling back over, especially with the negative economic data this week. And now we had closed the week just below our moving averages here on Friday. And I had said that to the downside, we really needed to see 65,000 hold. We did not see that hold on Friday. We closed below it. And last week I'd said if we close below 65,000, it is lookout below, and we are likely coming back down to the daily 200 somewhere around 55,000. And that is exactly what we are seeing. We gapped down over the weekend because Bitcoin doesn't close. It trades 24/7, but the futures do close. So this gap is just simply reflecting the difference in price over the weekend. Again, at a pretty important, significant level here. If we toss back to the weekly chart, we can see the previous time that we had kind of bottomed out, we had come in right around this level. We also have some wicks right in here at this level. I am not expecting this to hold. If we do roll over again, probably back down to 55,000. Honestly, anything down here in the 50 to 52,500 level, I'm going to assume is going to be a pretty significant buy zone. But we have some development to do until we get to that level, and this is just not a great look right now. Going out to crude light. Crude light is still getting massacred, and the story on this is on the longer time frames. I'm going to show weekly, and then we're actually going to jump out to a monthly chart on the crude light futures here, just so you can see what's going on. And if I zoom in here on the weekly chart and draw a couple diagonals, you can see that we are still just in this wedge pattern, waiting for a break one way or the other. We are testing below our weekly 200 again, not a great look. If we toss this out to a monthly chart, you can see that we did bottom on our RSI. We are trying to reclaim the bullish territory on crude light's RSI chart on a monthly setting, but the MACD tells a different story. It is threatening to break down into bearish territory. So not a clean read here. For crude light, we really need to get back above this diagonal resistance line for any kind of bullish thesis to reemerge. And we really have to hold this diagonal support line. If we break that, it is look out below, and I would not be shocked to see us come back down to 60 or maybe even below if that does give out. Quite a bit of a drop there. I mean, from current prices down to 60 would be another 18% lower. So that is kind of my worst case scenario. If we do get down to that level, you've got to assume to be a buyer in that area because our demand for crude light is not going away. But the supply and demand overall equation in the market right now is suffering and still leaning to the bears. Going out to gold. Gold trying to break out and hold. Had a lot of wick nonsense on Friday, dirtied that up a little bit, but really anything above 2,500 on gold probably signals another leg higher. If we toss this out to a weekly chart, we can see that we have closed officially above our breakout line. And I believe this is all-time highs. It is all-time highs, and we have actually driven significantly on the monthly chart. So I wouldn't be surprised if we stall a little bit here. If we get really bad economic data coming through the next couple of weeks, this could drive significantly higher. But if our economic data is stable, I would expect to see this chill out a little bit on the monthly and weekly timeframes and probably just go neutral more than anything. So I don't have a bullish read on gold going into the weeks ahead until we see what our economic data comes in and looks like. Going out to silver. Silver had a big M for murder pattern. This is a double top pattern that is typically associated with reversals. Broke down below that, closed below our moving averages on the weekly chart, and now we are coming back up to retest it. If this rolls over, honestly, coming back down to 26 is the base case, and that is going to really not be a great look on the daily chart. Right now, I think we have kind of tried our bump up into our decreasing moving averages, couldn't even quite get there. And now we are still below the 9. If we can reclaim the 9, I would expect a retest back up above this wick high here, coming back into the 20. But I don't expect us to break out above that in the short term. So I am looking more to the downside for silver than anything else. Finally, if we go out to UUP, and you can see it has been kind of a jumpy, skippy mess here with a bunch of gaps lately. Let's go out to the weekly chart to clean it up a little bit. And it actually looks like it might try to threaten down a breakdown based on the economic data that we had last week. The market really did not like that. Usually lower UUP index, weaker dollar, excuse me, is an indication of maybe support for the commodities market. But if our economic data is showing significant slowdowns, they can both move lower in tandem. So we really don't want to see this get out of control like we did back over here at the end of 2023. If we go back out to the S&P and look at that same time frame, going into right here, not a great look. So anyways, want to see some stability in it. Not 100% sure what to expect on this if we do break down Definitely don't see it going higher for the moment from where it is. I'm really seeing this as kind of an overall zone for UUP here for a little bit. But like I said, if we do break down on that, that is going to be significant news, and we're going to have to dig into the economic data when that happens to see what is going on and what our thesis is based on that break. But it does look, just from a technical perspective, like it wants to go neutral or potentially lower. Bullish case for UUP is off the table right now. And finally, let's go out to heat map. This is a 1 week performance just to wrap up so we can see what's going on in the market. And obviously, money is just bleeding out of the tech sector right now. The rotation trade, like I talked about the last few weeks, has intensified. And now we are starting to wonder, is this just a normal rotation out of the top of the market? Or is this maybe the start of something bigger? And I am starting to lean into the idea that this might be something bigger developing now. I think we're starting to see a little bit more rotation out of big names in the marketplace than I actually anticipated initially. So I'm keeping a close eye on this and all of the red that we see in this chart, making a note of where that red is. Right now, it's in capital markets, financial areas, and technology, and also a little bit of oil with crude light breaking down. So if that red starts to spread out and really cannibalize more of this heat map, that is not going to be a great sign, and we are likely heading lower in the overall market if that is the case. If we can see buyers starting to come back in on some of these big major players, signaling that it is risk on again, that is a different story. But right now, it does look like down is the likely path for the next week or two. With that, guys, take care. As always, trade safe. Let me know if you have any questions in the comments.